something, to me at least, doesn't feel right.
I do think we're going to go into a big recession, a big financial reset. Whoever's getting in right now are kind of buying, I think, near a high. I think we're going to go into a multi-week, potentially multi-month correction that could be 5, 8, 10, 15%. Gold is the barometer that says, hey, this is the ultimate sentiment. When the world gets nervous, they move into gold. They don't trust their currency, the dollar currency. They don't trust the stock market. They just don't trust their country. They move to physical gold to get out of the financial system. I like Bitcoin. I think it's going to go higher, but you just need to keep your eye on what the stock market does. So we're heavy in cash, knowing that the market is getting ready for a reset.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, the S&P is at all-time highs. Bitcoin's ripping once again. Gold is also flirting with new records. Silver just surged, and yet something, to me at least, doesn't feel right. And we're seeing it with Japan's bond market, which is starting to crack. US debt is continuing to spiral, and new tariffs are supposed to kick in within a few days. Markets rarely ring a bell at the top, but my guest today, Chris Vermeulen, has a habit of hearing things kind of before they happen. He was on our pod last June, warning of a potential market correction, and within weeks after he was on the pod, we got one. He's nailed some of the biggest turning points using pure technicals, no emotion, no noise. So today he's back to walk us through what he thinks the charts are saying about equities, gold, silver, Bitcoin, and potentially we'll get into oil as well. So Chris, welcome back to the pod. How you doing, man?
I'm good. Thanks for having me, Aaron. Yeah, pleasure.
Let's jump right into it. Last June, you were calling for a pretty significant correction. We did see a pretty notable pullback. I think it was late July, early August. Maybe not as deep as you were anticipating. What are you seeing in the major U.S. indices today? Are we comfortably back in an uptrend, or is there cause for concern?
Well, yeah. So there's no doubt we are back into an uptrend. Comfortably, most people feel comfortable and confident, but I do hear some bells ringing behind the scenes if you lift the hood to the markets. And it's funny because I have called some pretty big turning points. I'm definitely really good at calling shorter term turning points. The longer term ones that I'm talking about, which you and I touched on, is I do think we're going to go into a big recession, a big financial reset. Big turning points like that, you really have to let them play out. They're really tough to time. They can drag out for years, which has been the case. But these shorter term market corrections, like the one we talked about just last time you and I spoke, I think we're coming into another one of those. There's a lot of different things going on. And you mentioned that I use technicals and no sentiment. And, in a way, it's actually, I do use sentiment, not my own emotions, but I use the sentiment of the market. So the two most powerful tools I find are trend analysis, which is technical analysis, and then actually market sentiment, using the emotions of others. And there's a bunch of stuff happening right now that's telling us people are emotional. There's the markets are hitting all-time highs. And so we have two groups of people really getting hurt right now, causing a lot of emotions. And the first group is simply people who got shaken out of the market during the big tariff sell-off earlier this year. And they thought the market was eventually going to roll over and keep going even lower, but now they've missed the rally. So their fear kept them out of the market. Now they have FOMO because, as you mentioned, we're hitting all-time highs, and every day we hit a new high is like a knife sticking into those who aren't in the markets or didn't catch any of it, and like just twisting that knife. And so we have a lot of FOMO right now going on. I have what I call the inbox indicator. The pain among people who skipped this uptrend, it went from a bounce, turned to a rally, and now we've got all-time highs. The pain is at maximum levels, and it's forcing people right now to move into the most aggressive stocks to try to make up for the big gains that they've already missed. So we're seeing ARK ETFs, clean technology. We're seeing uranium stocks have done well. We're just starting to see the precious metal space come to life, but that's a bit different beast. The other thing that we're seeing is the put-call ratio. We have a low on the put-call ratio. I use moving averages on the put-call ratio because there's a big delay. And if you ever look at the chart, it's the noisiest chart ever. You have to smooth it out with moving averages. But we have very confident, comfortable people. They don't hear a bell ringing. They're not afraid of a correction. Or they just have enough FOMO that they're like, I'm taking the risk, I'm jumping in. And so they're buying call options left, right, and center. And we're just at a point now where if you're not in this, whoever's getting in right now are kind of buying, I think, near a high. I think we're going to go into a multi-week, potentially multi-month correction that could be 5, 8, 10, 15%. The big question is it the start of something bigger, or is it just a correction like we saw last summer that you and I talked about? And nobody knows until it unfolds, and you just have to follow the trends and take action accordingly. So that is like the one group. The FOMO people are getting hurt. The other people are those who have bet against the market. They're the more aggressive ones, buying inverse ETFs, buying put options, betting on the markets falling. And of course, the markets keep going higher. And they just see their accounts, they're in a worse situation because their accounts are going down every day versus the FOMO people who are just getting more angry every day. So that's the big scenario that we're at. And we're at a tipping point. The NASDAQ has just hit a 15% rally level from where the trend changed from a bounce to a rally. And almost every time when our strategy hits a 15% move on the NASDAQ, we go into a multi-week or multi-month correction. So that's one of the biggest, bells ringing right there is just statistically, this market is running out of steam and is probably going to have a correction. And a lot of people are buying here right at a high, I think.
You talk about being forced into the market. I had Diego Perillo on the other week, and that was kind of the topic of conversation is just, where do people go these days with inflation, with the cost of living, with the pursuit of a better life. And you're kind of forced into assets, right? Forced into equities and hard assets. But I wanted to touch on something that you brought up last summer, which was you talked about how a lot of these manufacturers had, ramped up the CapEx. I think it was like, after COVID, basically 22, 23, just before a potential downturn. And like I said, you called a pretty significant correction. But I hear Besant today talking about this influx of CapEx, people or companies ramping up, onshoring, building up for AI and so forth. Don't you think that could potentially give us a catalyst for a longer rally in the markets and maybe perhaps even an economic uptick?
Yeah, it could. I mean, if there's enough building and it's going to spark a lot of jobs, a lot of consumption and spending, which will, fuel certain pockets. The AI space and the tariff stuff is definitely, I think, forcing the hand of people to more move, maybe North America based, and also to refine for AI. So yeah, those things, if there's growth in those areas, it's definitely going to benefit those companies. Maybe the Dow does well. I'm not sure, but there's no doubt if people are starting to ramp up and trying to move everything in-house or in-country type thing, it's going to spark and help the economy, the local economy. But I think the way I see it is not just North America based. What I see in the overall big picture of all the sentiment and the money shifts and swings between various assets is the whole world is showing that it's fragile, it's weak, everything's kind of overextended, and it might drag out if we have some extra building going on, but that's just one pocket. There's a lot of different sectors and areas of the world. So I'm still leery of, the market just taking off and starting another big bull market. I know that's what people are fearing or people are thinking about, but in reality, I still see everything set up for a much bigger, deeper correction to come at some point. But again, we just have to let it unfold.
When you talk about, obviously, you're a technical trader, but when you talk about sentiment, like you do monitor sentiment, what are your top 3 sentiment gauges that you use?
Yeah, I use a lot. I use about, depending on how you look at it, 8 to 12 different kind of gauges, different things that I look at for trying to get an idea of where money's flowing and get the sentiment of the market. Gold is a very good barometer of what's going on. It is the clearest, the most significant one in terms of figuring out what's going on. And so if we were to go back and look at 2007, the stock market top, the stock market was at all-time highs. It had just pushed into some new nominal all-time highs, and gold was a top performer. Everybody was moving into gold. The stock market was all-time highs. The fact that gold was outperforming the stock market and had been screaming higher is very similar to where we are right now. Stocks are at
Mm-hmm.
all-time highs. Gold is at on the verge of breaking out to more all-time highs and have another big run. And if you were to look back at the currency back then, what the US dollar was doing, the dollar was the most hated, most undervalued, had sold off for like a year straight, very similar to where we are right now. The charts, when I overlay the two, they're almost identical in terms of the way gold moved, the dollar, where the dollar is positioned, and the price chart of the S&P 500. So I know it was a different market condition in terms of a different reason why the stock market sold off, but gold is the barometer that says, hey, this is the ultimate sentiment. When the world gets nervous, they move into gold. They don't trust their currency, the dollar currency. They don't trust the stock market. They just don't trust their country. They move to physical gold to get out of the financial system. It's just the ultimate kind of gauge. And so gold does really well. I think gold is about to rally to about 4,100. I think the stock market has maybe got a little bit more upside, but it is telling us that it's going to start to struggle here and probably pull back. So gold is really the best barometer. There's nothing that's going to tell you when there's a big turning point, like here's the day to do it. Major trends like this take months to unfold. And nothing in my book is confirmed until it's actually topped out, dropped significantly, and the trend has clearly changed in the big picture. So it's not about trying to pick the top. It's more or less let it unfold, let a lot of damage be done. And when there's enough damage done, you'll be like, okay, this uptrend is now done. And now it looks pretty bleak for the next, 8, 12 months, whatever. So gold is the best one to look at.
What were your indicators showing you prior to Trump's big tariff announcements 3 or 4 months ago? Like, were your indicators showing that the market was due for a significant correction, or did that catch you by surprise?
No, I mean, I could share my charts and show you what our strategy was saying. And actually, we have a sentiment chart that color codes based on the sentiment. But a long story short, our strategy, the price of the stock market had been going sideways for a couple of months. So it lost upward momentum. And then we saw money running for safety. They didn't know what was going on. So people were moving away from US equities, moving into the dollar. They're moving into utilities, defensive plays. They were just like, I don't know what's going to happen. And so our chart, I think it was like we had 4 small down days in a row. And our strategy said, hey, listen, not only has the trend now stalled out, but there's money flows out of everything. Like they're moving for, people are moving for safety, big money. And so our strategy got us out right up near the high, and we benefited. We were in an asset that went up in value that generated some slow return while the markets crashed, and we got back into the markets shortly after the bounce, and we've been riding it up to all-time highs. But the technicals, the chart tell us, the chart shows us what's going on based on a whole bunch of things behind the scene, which half of them are sentiment based in the markets.
Let's jump into a few of the key elements and assets I wanted to talk about. So you kind of touched on this, but gold's flirting again with all-time highs. Silver's had a strong move. But, we've seen false starts, particularly with silver, actually. But we've seen many of these false starts in recent years. From a technical standpoint, let's kind of touch on those two. Are we seeing a potentially... are you getting any confirmation of a breakout in silver and gold, or could this just be another rally that kind of fizzles out?
No, I mean, they have been in an uptrend for a while, so I don't think these rallies will fizzle out. I think silver has potential to run to about $40.70. If we look at the bigger picture, there's potential for silver to run to about $48. So it's about I think it's about a 13% gain from where it is as you and I are talking right now. So it has some upside potential. It's already popped and had a nice move in the last couple of weeks. So some of that upside has quickly been taken out, whereas gold has been trading sideways for a few months and it hasn't quite had that pop. Right now, gold actually has more upside potential, which probably shocks a lot of people. Gold is about 20% upside from where it is, as you and I are talking, to about 4,100 an ounce. It's got 20% upside. And that's actually very similar to what happened in 2007. We saw gold was the best play. Gold screamed higher. Silver did well. Gold miners were not worth it. They ended up moving up a little bit, but a lot of noise. And so I think the play here is gold. They look like they're going to go higher. I think they're starting there. It's an imminent breakout pretty much. And if gold starts to break out, if you're not in it, I think the breakout is tradable. You can play it up to about 4,100, which will probably happen very quick, probably over 2 or 3 weeks, it could have that giant run, maybe
Yeah.
a month. So there's some really good return on a very stable asset. Gold, you're not going to get your head handed on a silver platter the next
Yeah.
day, right? Silver
No.
is dangerous. Miners are dangerous in that regard. So it has the most opportunity, the least risk, and it has the highest probability. It wins the most trades. It's the most accurate with technical analysis. So that is kind of the play at this point.
That's an interesting take. I want to. I'm long gold. I'm long silver, but I'm also quite excitedly long Bitcoin. Have been for a while, but it's starting to rip again. Recently making, new highs.
Mm-hmm.
I don't know how I feel about this recent rally. I'm pretty indecisive on it. But what are you seeing? Is it just momentum driven, like a risk on pop, like everything else right now? Or do you see more of a sustainable breakout taking shape with Bitcoin?
Yeah, Bitcoin, there's no doubt it's in an uptrend. It has a really strong chart pattern. It is still tied to the stock market. It's decoupled over the last week a little bit. We've seen the stock market go up and Bitcoin's gone the opposite direction and vice versa. So there's a little bit of weird chatter there, but it does that because it's not the stock market. It can have a bit of movement on its own. Overall, Bitcoin looks like it could go to about $136 per Bitcoin. It's primed and ready for an explosive move. And when it happens, it's probably going to happen in 5 or 6 days. It'll be very quick. So it's primed and ready. It's locked and loaded. And we just actually got out of a Bitcoin trade about a week and a half ago. We hit the targets we wanted. We've moved aside. And part of that is just the strategy that we're using there. But again, the NASDAQ is primed and ready for a correction. It's already showing some volatility. It's gapped up. It's got sold off in the last couple sessions. Every time it moves up, it gets hit with a wave of selling. So there's some sellers distribution going on. I like Bitcoin. I think it's going to go higher, but you just need to keep your eye on what the stock market does, because if the stock market rolls over, Bitcoin's probably just going to get pulled down. So I wouldn't get out of it. If you're in Bitcoin, I mean, I like it. I think it's going to pop. And I wouldn't get overly excited when it hits 136. I'd be happy and close it out, wait for like a reset. And that's kind of the best thing to do. Cause after that, it could get hit really hard, because the timing with the market and everything else, the sentiment that's unfolding shows Bitcoin could have a huge correction. It could be back down in the 80s, believe it or not. After the market turns direction. So
yeah, and the correlation between the NASDAQ and Bitcoin, I mean, just anecdotally from my personal observations, it seems pretty tied together, the NASDAQ and Bitcoin. Is that from your observations?
Yeah, they move
accurate?
Pretty much together. Not every day, but it's a very similar group of people, right? People want to get into fast moving opportunities, growth stocks, high tech, new exciting things. So it's when those people are bullish, they're buying both. When they're scared, they're dumping both.
Exactly.
It's the same. It's a school of fish mentality.
We've touched on gold, silver, Bitcoin. I want to touch on oil. It feels pretty indecisive right now. Some days, to me, it looks like it's ready to run, and other days it just kind of fades. More days, I would say, it just kind of fades lately.
Yeah.
And with global demand questions, tariffs, geopolitical risks at play, what's the technical picture for WTI right now?
Yeah, technical picture is definitely bearish. It's been in a downtrend for a long time. There was a recent big rally up to about $78 a barrel, but that was totally news driven. Obviously, there was bombs being dropped and all that. So it just skyrocketed. As soon as there's war, we tend to see gold and oil pop. But it fizzled out. Within a week, all that huge gain from like $64 a barrel all the way up to 78, it was completely wiped out and right back down. And that's typical for a news-driven move. It's very difficult to trade news because, first of all, you never know when it's coming out. You don't know how the algos and people are going to react to it. And then on top of it, whatever it does on that news is probably going to be given back shortly after. So trading news is very difficult. When you take that big spike out, that news-driven spike, the trend is clearly down. It looks like oil wants to head right back down to about $56 a barrel. The energy sector, like XLE of energy stocks, it's starting to break down. It's showing signs of starting a downtrend, which coincides with the bearish pattern that's on oil. Oil has dropped over the past month and a half. It's gone sideways in what looks to be a big bear flag, which points to lower pricing. And the fact that energy stocks are also starting to point that direction is a really good sign. Usually energy stocks will move first and then the underlying commodity if it's going to be a really strong move. So that's kind of what I'm looking for in terms of the energy space. We're actually looking at putting on an inverse trade on XLE, there's an inverse ETF for the energy sector. As it starts to unfold, it's not quite ready yet, but I think there's going to be a great way to play the drop in oil and the drop in energy stocks that'll happen probably at the same time.
So you're looking to kind of prepare for this drop and then position back in, or
we won't buy back
remember
in. It's a pure discretionary trade. We're just taking advantage of, hey, both trends are down. The energy sector space has this huge divergence. It's got like a more or less a multi-year setup that's finally creating a trigger. It's actually very similar to the multi-year setup we did in Bitcoin last year. It was like a 40% gain that felt like overnight. It's just a really strong big chart pattern that when it unfolds and you get involved, we just get in, we play the move. Hopefully it only lasts a couple of weeks and we're out, and we can make 20 to 30+% on a really high probability trade with tons of momentum, meaning right when we get into it, it just keeps on going and going, and we hit our targets and we scale out. So I don't trade the energy space in terms of I don't buy, invest back into it. Once I just find a trade, make the money, move out, wait for something to set up in another asset that I know, and let these patterns unfold. And I look at chart patterns that are much bigger than everyone else. Most people are looking for swing trades and day trades, or get in, get out, catch like weekly moves. I look for the big ones that people don't want to wait for. They don't want to wait months and months for something to unfold and hope it triggers and gives you a trade and hope it works, or else you just wasted months, right? So I have a strategy where we're always involved and we're constantly pulling money out of the market with simple ETF trades. But then we have these discretionary trades on the side. We're like, hey guys, here's our fun trade that we can do with a small portion, and get that thrill of something that moves fast. And so that's all the energy is. It's just, let's just pull some money out of the market while it drops. And it's a pretty cool feeling to make money when everything collapses. Like, a lot of people never really succeed at it. It's a very different game, but it's pretty, once you've done it once, you make money as everybody's losing.
I'm still waiting for my first time doing well when the markets are going down. That's just why I really enjoyed chatting with you too, because I'm a buy and hold guy, right? Anyway, I digress. So given kind of the cross currents right now, equities at highs, there's a lot of macro stress, the technical signals you've got a pretty good finger on. How are you positioning a large portion of your capital today? Are you in cash? It sounds like you're kind of rotating in and out.
Yes.
How are you playing the market today? By and large, what's the overall strategy?
Yeah. So the overall strategy is I play waves and cycles that go through the markets. There's like 5 to 12 of them a year. So every 2 months or every month, there might be an opportunity, right? It's really slow. Most people do not want to wait that long for a trade. And there's opportunity where people aren't willing to wait. And so that's part of the reason why it works. But where we are right now is we had a beautiful sell-off in the market early this year. We rotated out. We moved to a cash position where we collect daily interest in dividend payments. And then we rotated back into both the S&P 500 and the NASDAQ as the bounce started, and it turned into a rally. And so we've been scaling out as the market's been hitting our targets. So we're fully out of QQQ as of like last week. We got out at a 15% gain for the last portion of that trade. And that money moves over to just a cash dividend paying position with no downside risk. So we just can, grow our account about a third percent every month while we wait for a new opportunity. And the other half of it is in the SPY, which is long the S&P 500. And we're getting close to hitting our next target, which is about 12.5% to the upside. Hopefully we'll hit that this week or in the next week or so we can lock in more gains, move our stops up. But we're almost all in cash because we've closed out all of our QQQ position, and we have just the last, we got about half of our SPY position left. So we're heavy in cash, knowing that the market is getting ready for a reset. We don't have a whole lot of downside. If the market crashes and rolls over, well, we've got a trailing stop that our position will lock in a gain, just not as much as we wanted on the SPY. So we don't really care what the market does. At this point, we just want it to go a bit higher so we can sell off a little bit more of our SPY at the next target. And then in a perfect world, then it can roll over and reset and either give us a new entry to get in a month or so as the market potentially goes to new all-time highs again, or it starts a much bigger correction and we move into something else that goes up in value. It could be the dollar index ETF, could be a cash position. Bonds aren't a setup. Bonds can provide opportunity when the markets fall, but they're not in that market environment right now. But when we
Mm.
do get into a bear market, a real downtrend, then we can buy an inverse ETF. So as the market falls, it goes up in value, and that is a life changing. Once you've done that, it's all you really want to do. I remember there was a time after I learned to make money from a falling market. I still do this every month almost. There'll be a big rally in the stock market for the day. There'll be a particular setup, and I'll occasionally do a day trade with SP 500 futures. And at the end of the day, I'll actually short the market, knowing it's overdone. There's going to be a lot of longs closing out their position for the day to book some profits, and I'll just catch like a 15, 20-minute pullback and make my money on the shorts. I'm really good at making money when the market drops, even on the strongest up days. It's what I really focused on. I used to just trade the Dow Jones futures, day trade, and I only shorted for years. I did that. So I really love the short side, but now with a large investment account and I help a lot of people, I don't focus on that risk strategy. I focus on 5 to 12 waves that roll through the market. We use ETFs. We're in these trades for a month or so. We scale out as the wave weakens, and knowing a trend's changing, and we'll move to a different asset. So it's kind of how I go about it in our positioning.
When we last spoke, Biden was in power, right? And I don't think too many people thought Trump was going to win, June of last year. Maybe they did. Regardless, there's different strategies under different regimes, right? Have you noticed a huge difference in market behavior since Trump took over?
I wouldn't say there's nothing changes for us depending on what party wins. We really follow price. The difference is, as you just mentioned, is now we have these like social tweet landmines that land, right? And so we do have somebody who's in power who loves to drop little snippets and tidbits and comments that can cause quick moves. So it adds a little more volatility. But this is the nice thing about the strategy that I play. The trades that I trade are much larger, and they can carry more of the news, the noise, those wiggles that the president kind of forces into the markets, where people who are day trading, swing trading, scalping, whatever, those things can annihilate them and put them offside, and they take a loss, and then they're like, I hate this market, it's rigged, and Trump screws everything. So that's the nice thing about trading a strategy that's a little bit bigger. You can like, okay, well, he dropped another bomb today. It caused a heck of a day, but it doesn't kick us out of a trade because we have a bigger picture, a bigger pattern at play. So that's the nice thing about it. That's the only real difference in terms of how we don't change anything. It's just we have to put up with that. And it's just part of the game, really.
Does your strategy seems pretty formulaic almost, right? And so how do you get better year to year then? How do you improve as a trader?
Well, the biggest way to improve is controlling your emotions. And following a strategy. Most people, even if you give them a winning strategy, they still fail at it. I have a lot of subscribers that skip the last trade, and it was like the best trade we've had in a long time. And and then of course they'll get into the next one. It could be a small loss, and then they get nervous. So if you can follow a strategy, that's the biggest thing. But how do I get better? I mean, I'm constantly analyzing the markets. I'm constantly looking at how can I refine the strategy? What keeps happening or not happening that we could tighten something up, change our targets, manage how we're going to identify trend changes. We do make some small changes here and there, very minor. The overall fundamental of what's going on doesn't change. It just might be we have more volatility now, so we have to maybe cut our position size in half, but double our targets. So you have to adjust with volatility too, right? So when the market goes wild, we still trade the same strategy, the same triggers kick in, but the way we trade it is a little bit different. And our position sizing, our targets will be smaller and stuff like that. So how do we get better? I mean, just put in time. Eventually, I can go a year or two and not really get a whole lot better. Nothing really clicks. And then suddenly a member or something happens, somebody shares something. I'm like, ooh, that's really interesting to look a little deeper in. And I go and I dive in. I'm like, you know what? This actually reduces risk, or this actually gives us a little bit more upside potential or a better confirmation for a trigger. So very rarely, I buy a lot of trading courses. I buy a lot of all kinds of self-help stuff. I'm always looking for one little nugget that makes me better in any way, shape, or form. And so I'm always attuned to it. And so I'll see somebody say or do something. I'll be like, I'm going to dive into that. it's pretty rare now in the markets. I haven't found stuff that have made things a whole lot better. It's really just following the strategy and sticking with it at this point. But we are finding little tiny things that do help make it easier to follow and help people follow the strategy better. Because that's the biggest part is people's emotions get in the way. They skip trades, or we get into a winning trade and they don't get out. They're like, why do we want to get out? You say we're in an uptrend. We're up 15%. I don't want to get out. I'm like, okay, well, and then the market will correct, right? And they'll give back half of it in a couple of days. And then they'll be like, oh, I should have listened. So it's people always trying to outsmart the markets or the system. And they have fear of giving up on missing out on gains, or they have fear after it starts to fall of losing more. And it just causes terrible timing.
I definitely suffer from FOMO. Corrections to me, if I get too frustrated, I just shut the screen off. I don't think about my portfolio and corrections, or I back up the truck and just buy more. But FOMO is powerful for me. I can see why people would want to stay in a trade despite your guidance. Now, how much tech are you applying into your work? And when I say tech, I mean, are you using AI at all in what you're doing now, in any way, shape, or form?
For business, I use AI, but for trading, I zero. I don't have any AI. So years ago, back in 2011 and 12, I used to run an automated trading strategy. It wasn't AI, but it was robotic. It would trade and generate the trades and trigger and execute, portfolios, all that stuff on its own. So I'm aware of automated trading and robots programming it to follow rules. We did that for years, and it was a day trading strategy. In fact, it's the strategy I use now for investing. The strategy can be broken down on any time frame. We traded the 30-minute chart. A robot traded it. Now I trade the daily and weekly chart, and it's the same strategy. But I'm not a big fan of AI. I'm not when it comes to robots. I'm not a fan of AI or just automated trading systems, because there's almost always a particular market set up, a combination of data that comes together, and the robot's like, I don't know what to do, buy, or sell, or doesn't do anything. And you're like, holy crap, right? So I really don't trust systems, because we can never ever think of every possible scenario of data feeds and indicators coming in that could cause a glitch that could make the robot do something. And you only have to have like a few glitches happen like that, especially if it's with a lot of people or your live accounts. And you're like, you know what? I absolutely hate robots and automated trading systems. So I don't touch it. And that's why I've moved away to slower, longer strategies. I used to run a futures day trading room. I did that for years. I mean, I've done it all. I love it. It's a rush, but it's a job, and it's a grind, and it's difficult. And now I'm at a strategy where it's like, okay, I just want to just check on the markets every morning or every night. I know when a trade is coming, usually 3 or 4 days in advance, because everything is coming together. And I always tell my followers, I'm like, get ready. We're about to have a trend change, or like a buy signal, or we should hit a target. Just be ready. That's what I like. I don't need to be glued to the screen. I can, it just gives you time and gives you more of the lifestyle. I used to have day trading in my basement of my old house a decade or two ago. And I had 2 internet lines coming in. So if one goes down, the other one keeps feeding it. One's cable, one's another company. And it's not my thing. It was fun at the time when I was young. That was probably 15 plus years ago. But I just want the best probability trades that you can put like your whole portfolio in and watch your whole account just drag higher, not find 30 or 100 trades over the next month and have 10 different open positions and you're running around with your head cut off. It's hard enough to do one good strategy, one position. Then for people that have a whole bunch, like it's just a nightmare. People don't realize multiple positions. It really undermines your focus and your skill set.
Yeah, well said. Needless to say, you're not worried about AI taking over your business, so that's good. Now, when you talk about some of your subscribers, are most of these just retail investors, or do you have kind of Wall Street, Bay Street type clients as well?
Yeah, we've got everybody. I've got a lot of financial advisors. Most of them are independent, active traded investors themselves, but tons of advisors. We've got hedge funds. We've got a few billionaires on there. A lot of like they're CEOs. A lot of them are professionals. They're doctors, they're lawyers, they're pilots, dentists. I find the people who stick with my strategy, who they have wealth, they have a lifestyle they want to protect, both of them, and they're very focused. Like they're willing to put in the years at school to become an expert. They think long term. And so people who I can't really help are the short-term thinkers of, oh, this just moved today. How come we didn't get a piece of it? Or why are we getting out now? It hasn't, technically topped.
Yeah.
And so I help people who get what I'm doing. They see the value, which a huge chunk is like, I'll protect your account and your mental health, no matter what the market does. And we can continue to hit all-time highs like year after year. And so I need a long-term thinker who's like, okay, it's not about getting a bunch of trades. It's not about satisfying myself right now on a new trade. I'm just going to wait for him to issue another trade, and we'll trade it together. And I trade my portfolio, and I just share my portfolio and trades with members. So we're all doing the exact same thing. We enter at the same time. We enter the same ETFs. So it's, so my people are generally, experts or professionals, long planners. They want a portion of their capital managed differently or traded differently from what they're doing.
Well, before I let you go, tell us where our viewers can find you online. Tell us about Technical Traders.
Yeah, well, there's a couple spots. Easiest one to get a feel for what I do and see what I do, drawing on the charts and all that stuff, is to go to YouTube, go to The Technical Traders. I've got a great channel there. And then you can go to my website, thetechnicaltraders.com. And there is where I share my newsletters. I share the trades that I put on, 5 to 12 ETF trades a year. We do have an options trading newsletter which Brian runs. It's all about writing and selling options. So it's more advanced. You definitely need like a level 3 account, but it's how to pull money out of the market every month with a bunch of options trades. Very low downside risk because we're selling options. Most options, expire worthless. And if you're the one selling them and getting a rent for them, a premium, then you got pretty good odds in your side. So that's another way to do it. But the last way is really to go to Amazon. My book, Technical Trading Mastery. I have a new edition just published actually yesterday. It was updated and a new cover is coming on there. But on there, I share my short-term charts, my 30-minute charts, how to set it up, all the settings, how to know when the market, like the stock index or the S&P 500, the NASDAQ, when they're overbought, oversold. I also share the indicators and the formulas, how to set up the panic selling and the FOMO buying indicators, so you know when the market's about to turn intraday. Amazing intraday and momentum trading signals. So I'm pretty excited about that new edition of the book out because it has everything you need. You just go into TradingView or whatever platform you're on, you put in these formulas, and you can get the pulse on the market every day. You know when people are freaking out, you know when they're panicking, and when you're in control, when you see everyone else scared, you don't become scared anymore. You feel empowered, you feel in control. And that's the nice thing about these indicators is it tells us when everybody's an extreme buyer or extreme seller, and it's an opportunity. And the chart, the trends and stuff that I share in there allow you to take advantage and trade those highs and lows multiple times, usually a week. It's pretty cool.
Chris, been an absolute pleasure, man. Thanks for joining me again today. Left me with lots to think about for my own portfolio. So I appreciate your time.
Thanks, Aaron.